Good morning, everybody, or good afternoon, or good evening, depending on where you are. I want first to welcome you to the Levy Economics Institute's 30th annual conference. These annual conferences before the COVID-19 pandemic were physically held in our facilities in Annandale, but I hope the virtual nature we use post-COVID will not diminish the importance of the speakers' perspectives on the crucial economic issues to be analyzed and discussed. The usual theme of these annual conferences is on the conditions, to study the conditions and prospects of the US and the world economies, and to consider various policy options to solve the crucially important and pressing problems facing these economies. In this year's conference, we will again analyze the existing conditions and consider the prospects and challenges facing the US economy in the next 2 to 3 years. We will hear the views from well-respected financial executives, and the Levy Institute's views fashioned from the results of our long-established macroeconomic stock flow consistent model. Our model, originally constructed by the late Wayne Godley, simulates outcomes of the US economy's financial balances, which are important indicators denoting the fiscal policy stance, the private sector saving, expenditures and investment outlays, and the current account balance. The model uses reasonable assumptions on the expected growth path of government revenues, consumption and investment, influencing the private sector's expenditures and borrowing behavior, and how these two ultimately influence the trade balance. The simulations show the likely growth rates of GDP under different scenarios of the private and public sector behavior. In this year's conference, we will also consider 3 other important, timely, and related issues. That is inflation, unemployment and job creation, and climate change, and the necessary fiscal and monetary policies to deal with these issues. The US and other economies are showing signs of increasing fragility emanating from low growth, inflationary pressures, rising interest rates, and in the US in particular, increasing numbers of employee layoffs, not only in the tech industry, but in other sectors as well, as the recent announcement from Disney company testifies. Employment statistics show low levels of unemployment, but a deeper examination shows the civilian sector force participation to be below the pre-pandemic and long-term average, large numbers of individuals to be out of the labor force wanting a job, others marginally attracted to the labor force or working part-time, wishing a full-time job. Taking all these metrics into account, tell a different story from the one we get from the low unemployment rates. The panel on unemployment and job creation will discuss the labor market conditions and propose policies to move the economy closer to true full employment. We recently witnessed the fragility of the financial system with the collapse of Silicon Valley Bank, Signature Bank, and just this week, First Republic, not to mention the mega collapse of Credit Suisse. When 5 years ago, President Trump signed legislation exempting regional banks from certain elements of the Dodd-Frank financial reform, if Hyman Minsky were alive, he would have cautioned once more that deregulating banks is dangerous. The Fed, of course, blames the collapse of these banks, which qualified for reduced regulation under the Trump exemption, for mismanagement and underpricing risks by failing to consider the impact of higher interest rates, although Michael Barr, the Fed's vice chairman for supervision, admitted the weaknesses in regulation and supervision. The Fed's aggressive moves to increase interest rates will be addressed by the speakers in the last panel, who will undoubtedly question whether this is the appropriate policy to curb what most likely will eventually prove to be transitory inflation. As we all know, current inflation started in the period of the pandemic, caused mainly from supply chain bottlenecks, boosting costs and profit increases, and curtailing production of key products. It worsened with the high price increases in energy and food-related products caused to a large extent by the Ukrainian-Russian war. The prospects and the ongoing challenges for the US and the world economies are significantly affected by the continuing Ukrainian-Russian conflict. The recent curtailment of oil production by the OPEC countries, and the negative effects from monetary policy tightening. Recent advanced estimates for the US of GDP are below expectations and show anemic growth rates with large negative effects on employment and incomes. Adding to all these is the urgent need to design and implement effective policies for the greening of the economy. President Biden's economic growth strategy, coined by Treasury Secretary Yellen as modern supply-side economics, aims at increasing aggregate demand, and it also includes proposals for climate change related to business subsidies, technical training, and green infrastructure projects. The Build Back Better and Inflation Reduction Acts, unfortunately, were severely curtailed, and increasing entrenchment of this seems inevitable in light of the congressional cuts announced last week in the debate on raising the debt ceiling. Environmentalist and climate research organizations caution that government inaction on climate change will become a tragedy in the very near horizon. Assessing physical and transitional risks isn't easy, but reasonable modeling exercises run by the network of 116 central banks for greening the financial system show the devastating effects on communities, businesses, and households if economies continue on the proverbial path of business as usual. It is therefore incumbent on policymakers to act across many climate policy fronts, from energy, infrastructure, technical training, and financial services, all necessary to effectively deal with both physical and transitional risks. The speakers in the climate change panel are established experts in this area and will undoubtedly report on the challenges that lie ahead. It should be noted that the US is unfortunately behind other economies in planning for the climate change effects and taking the necessary compliance steps as agreed upon in the Paris Agreement, despite the seemingly large 30-year commitments of $130 trillion from many US-based financial institutions announced by Mark Carney in the 2021 Glasgow UN Climate Change Conference. The talks and discussion in the last panel will confirm the economic and financial fragility of the US, illustrated by the volatility in the equity and bond markets, precipitated by the insistence of the Fed, the ECB, the Bank of England, and other central banks to continue increasing monetary tightening. This wrong-headed policy will further amplify the prospects of recession, with consequent effects of decreasing employment and incomes, and the survival of low credit-rated firms. The speakers chosen for each of the 4 issue focus panels are well-known researchers in their respective areas, and we hope their views will enhance our understanding on these challenges and the policies required to address them. I hope you will enjoy the presentations and discussions that follow. Your comments and suggestions are always welcome, and I want to thank you all for attending, and I wish you to enjoy the conference. Thank you, and now I want to call on Joe Weisenthal from Bloomberg to moderate the first panel on employment, unemployment, and job creation. Thank you, Joe.
Thank you so much. I really appreciate that introduction. I appreciate getting the opportunity to moderate this panel. And of course, very excited that the first panel is on unemployment and job creation, particularly at a time when so much of the macro conversation seems to assume that the only interesting question is, how do we get down inflation? Which I think is also an important question. But the fact that we still, that we're talking about that the labor side is important, that these questions are not over, that there are still issues with regards to the labor market, that perhaps the labor market could even get better than it is, if we don't just take it for granted that it must weaken. I appreciate this chance. So I'm really excited about our panelists. I'm going to be speaking with Daniel Alpert, Westwood Capital and Cornell Law School, Pavlina Tcherneva of Levy Economics Institute and Bard College, and Skanda Amarnath of Employ America. Both have, all of them have come with a bit of a presentation. So I'm just going to turn it over to each one of them to sort of give their general perspectives on where things stand now on the subject of unemployment and job creation in the state of macro. And then then maybe we'll have a bit of a chat after hearing from each of them. So Daniel, how about I kick it off with you in terms of where you see things right now?
Thanks, Joe. First, thank you to Dimitri and to the Institute for asking me to speak. With your permission and Lindsay's cooperation, I think I'll try to share my screen, which is always a little bit of a challenge. Let's see if I can do this. There we go. Hopefully you're seeing it. And there we go. Are we, Joe, are we okay? Thumbs up? Good, excellent. So I call this post-pandemic employment wage boomerang, a fertile ground for policy overreaction, which probably tells you what you're about to hear. The dangers of rear vision policymaking are very significant in this post-pandemic U.S. economy. My contention is that the pandemic's impact on employment, wages, and income are sui generis and not conventionally cyclical. One of the things that occurred during the pandemic is we saw a lot of movement in incomes, wages and incomes, some classes of workers who actually benefited even on an inflation-adjusted basis for a period of time, and that is not a sustained paradigm shift, reversing years of declining labor share production. It's really just a factor of the pandemic and its dislocations. High inflation in the price of goods and services was both supply and demand driven, as Dimitri indicated. Supply side effects on the goods side have almost ended entirely. I'll address that. Demand side effects persist, but are being eroded due mostly to non-monetary factors, and I'll address that as well. And I know I'm addressing inflation as well as employment, but I think they've got to be connected in this period. Bottom line is anchoring aggressive, restrictive monetary or fiscal policy to employment and labor aggregates risks missing critical nuances that would tend to indicate a far more patient approach. Let's put aside the fact, as Dimitri referred to, that we've lost 10% of the top 30 banks over the last few weeks, and get back to the issue of how monetary policy probably did not take a sufficiently granular approach. We're going to cover service versus goods producing employment, ratio of production and non-supervisory employment to total employment, inflation-adjusted weekly incomes of holders of production and non-supervisory jobs to those in management and other non-production positions, the job quality index of lower versus higher income jobs, and the ratio of weekly incomes of those in higher income jobs to those in lower income jobs. But first, let's talk about why hike in May and go away, which is what happened yesterday, hopefully, needs to remain the mantra going forward. This is core goods inflation. As you can see, it's pretty much dissipated. My favorite little data point is on the right side, which is the cost of shipping from China to the US. It reached its peak over $20,000 a container. It's now below or at $1,000. What this represents, and this is the important thing for labor, is that exogenous and extraterritorial labor has been fully reconnected with US demand for tradables. And we'll come back to supply constraints on non-shelter core services in a little bit. Going back to the demand side, the two takeaways here are that we had two major supplement interventions by the government on the fiscal side. One of them was in the 2020s, which supplemented lost income. As you can see from this, the income was largely restored by 2021, and we had government supplements that were even larger to household income, which resulted in considerable additional savings that were banked and have caused the extension of demand into this period. This is just looking at the same data on an inflation-adjusted basis. If you look at the dotted green line, compensation to employees, you can see it bobble around a little bit, but nothing compared to the effect of the government supplements, which created huge spikes, which pushed overall personal income, which is the dotted black line at the top of the chart, up to the levels that you see. Going to the issue of the excess savings, the estimate is that it topped out at about $2.2 trillion. Through January of this year, it was spent down by about 1.1 trillion. My estimate is that at this point, it's been spent down by about 1.5 to 1.6 trillion. And the big issue right now is where it resides. The conventional wisdom is that this excess savings is no longer extant in the bottom three quintiles. I am not sure that that's the case. I think that the bottom three quintiles still have some cash banked. The big issue is what's going on in the second quintile, which is obviously more consumptive than the top, and whether or not they have burned through their savings and are starting to hit their credit lines. That issue is still unanswered. But what we do know is come June, one of the smaller issues that created this excess savings, which is the forbearance on student loans, is going away. Now, that total forbearance, just for your information, totaled about 211 billion in payments that didn't have to be made during this period. That's going away. Now, obviously, the 211 billion doesn't have to be paid back immediately, but that's going away come June and end of June, and that is going to create its own problems. To the extent that bank deposits are a driver of lending, and I have an issue with that, but to the extent they are, and to the extent that inflation is financed, and at the margin, I believe inflation late in cyclical periods, and again, I caution that this is not a conventional cycle, to the extent that inflation is a financed phenomenon, The withdrawal of deposits, not only because of the saving, but also because of Fed policy that has forced people to seek returns in the money market. That withdrawal of deposits certainly is not going to spur increased demand. It's going to dull increased demand going forward. So that brings us back to labor as the principal supply constraint in non-housing core service sectors, which is the area that the Fed is most concerned about. Now, it is true that we've had readily visible labor shortage for low wage, low hours work in this post-pandemic period. There are a number of factors that could have contributed to that. I think the history is not written on it yet and requires far more additional research. Those include immigration issues, the excess savings itself, regional flows. I'll give you an example. Hurricane Ian, for example, took a lot of construction labor out of the rest of the Southeast and pulled it into Florida. You have other phenomena like that moved lower wage labor from one area to another. Early retirements and COVID fears obviously were a factor during the course of the pandemic. And then we have what I think probably hasn't been adequately written about, which are protracted benefit cliff issues. And I do urge people to look to the Atlanta Fed's cliff dashboard to fully understand how that works. You have people who literally aren't going back to work because at the margin, they will lose public benefits and actually see their household income decline. But putting that all aside, there's a lot of really weird stuff happening in labor and employment post-pandemic that has really severely clouded policy analysis. Obviously, the well-known one was the super high job openings that are now reverting. If you look at the chart to the right of this slide, you'll see that we've seen a decline in Q1 of 1.65 million job openings. And you can see the sectors in which they occurred. And ironically, of course, these are the sectors that report some of the biggest shortages, especially leisure and hospitality. We also have the phenomenon of phantom job listings, which is something that's been reported on. The notion that businesses have been posting, because it's so cheap to do so, posting job listings for jobs that just simply don't exist and that they don't intend to hire for. And then we have this very strange phenomenon of do-nothing jobs in the tech sector, workers who were hired to sit around and do nothing in anticipation of business growth that never occurred. So clearly this isn't your grandfather's recovery. And let's take a heterodox view of the prevailing labor situation in the next few slides. We'll start here with what I think is fairly well known, but I think is worth pointing out. And that is the dramatic change in the post-war U.S. employment situation through the GFC, which was the continued shift to service employment. And as you can see, it plateaued right around the time of the GFC, where we hit peak service employment, for lack of a better term. And the pandemic really didn't change things. You know, there's a lot of talk about onshoring of manufacturing and other goods production jobs. Truth is, pandemic really kept it right about where it was, a little bit higher. In fact, service jobs are 86.3% of total employment. So, really not a big shift here. But certainly no worsening. A related factor, I think, that is also worth keeping in mind is you really have to watch hours worked in the service sector. Your service sector job of today is not your father's service sector job. In the or at least my father's service sector job, I admit there are a lot of younger people on this call. But the fact is that back in the 1960s and 70s, service jobs offered a full week of work. Today, they average, around 32 hours of work. And that's a very, very important phenomenon, especially when you get down to some of the larger sectors like leisure and hospitality, that offer far fewer hours of work. So, a job in services is just simply not the same as a job in goods production, which typically offer far more hours of work. This is a graph of the U.S. private sector job quality index that I led the creation of, along with colleagues at Cornell and at the University of Missouri, Kansas City. This index currently resides at the University of Buffalo School of Management. It's generated on Jobs Day immediately after the jobs data comes out, and it can be found at jobqualityindex.com. The index is a ratio of the number of production non-supervisory jobs above the average weekly income for all production and non-supervisory jobs divided by the number of such jobs below the average weekly income. And as you can see, going back to 1990, where the data began, we were at a far more equal distribution between high wage, high hour jobs and low wage, low hour jobs in terms of the total employment base. That curve has continually declined until it hit its nadir in 2012 after the GFC. That decline obviously represents the fact that more employment is low wage, low hour. Now, during the pandemic period, as you can see, that this data became severely distorted. You can't lose 20 million mostly service jobs without having the data distort, as you see. And so that period should be ignored. But in the most recent period, you've seen a significant recovery. In fact, a recovery in excess of the recovery you saw during the peak of the, towards the end of the Obama administration. And that is salutary. It's a good thing because that means that we are balancing out at least slightly the distribution of jobs between low wage, low hour and high wage, high hour, which is good for the economy and good for labor. This is another graph using similar data, same data, that is maybe a little bit hard to read because the dates and the axis is a little small. But this shows you, again, going back to 1990, the ratio between the average weekly incomes. I know the top says weekly wages. It's actually weekly incomes of production non-supervisory works in each of those categories, high and low. And as you can see, in the 1990s, it averaged about a 1.95 multiple of high to low, and that became exaggerated to about 2.15 by about 2016. So that was a higher degree of inequality. That improved and then drastically improved as a result of the pandemic, again, ignoring that pandemic era bobble. Where we are today, though, represents, much more the situation that we saw in the 1990s. So we have erased a considerable degree of inequality on this measure. Again, this is a good thing and should not be lost. Now we get to some really strange data, which is the ratio of production non-supervisory employees to all employees. We have lost a lot of working jobs, and keep in mind that production non-supervisory employment is typically around 82 to 82.5% of employment. That dropped significantly during the pandemic. Obviously, during the pandemic itself, you can imagine we eliminated a lot of service jobs. So again, ignore that 1920 or 2020 period. Boy, am I living in the wrong century. Ignore the 2020 period, and go right to where we are today. And where we are today is a considerable loss of production non-supervisory workers. Now, some of that is due to the fact that people are just not picking up those jobs. But when we get to the reality of what's happened, and this is very, very strange, 52.5% of jobs added from pre-pandemic, that's February of 2020, before the pandemic, to February of 2023, were non-production and supervisory jobs, meaning bosses and managers. And this is a very, very strange phenomenon. Quite frankly, I've never seen before during any period of time. In fact, we've added during that 3-year period a net 3.3 million jobs, and of them 1.7 million or 1.74 million have been management jobs, which is basically almost all of the increase in the labor force. Now, admittedly, the increase in the labor force has been very, very sluggish because of the drop in the LFPR. But this is a phenomenon that, again, you have to take into consideration in order to understand what's going on. Now, keep in mind that that's relative to the overall stock of about 18% of management jobs in the total private sector. So something weird is going on here. Now, where were all these management jobs added? Some examples: healthcare, 72% of jobs added during this period were in management. Wholesale trade, 47%. In two categories that actually lost overall jobs from 2020 to 2023, leisure and hospitality and retail actually gained supervisory jobs. So again, to fully understand what's going on in the labor and employment market today, you need to disaggregate the data. Now, here's a graph that most of you, I think, are probably familiar with, which is that you've seen some. Well, this is inflation adjusted data. So this is hours worked at the top, hourly wages in red, and weekly incomes. The trend going back to 2012. Pandemic obviously caused all that distortion that you see in the 2020 period. And when you look at the far right, you see that not only has the overall workers been pushed down below trend on an inflation adjusted basis, but they've actually nominally been pushed below their incomes on an inflation adjusted basis prior to the pandemic. Now, again, when you disaggregate this and look just at the production and non-supervisory employees, the picture looks a little different. In fact, they have maintained their condition on both wages and incomes, and a lot of that is due to the fact that they've picked up hours. If you look at the top, and this is a very, very important phenomenon, because when you look at the average worker, he's doing pretty decently. And one of the reasons I think that we don't have pitchforks and torches in the street on the subject of inflation, and that I believe the Fed is perhaps overreacting, is that the little guy's doing pretty well. Now, this had to come at somebody's cost. This is a very strange graph. This is extrapolating out non-production and supervisory workers from the total data. And as you can see, on a weekly income basis, well, they've lost a ton. And when you look at why, a lot of that is declining hours. So, what's the argument? Overstaffing? The truth is, I really don't know. A lot more work needs to be done on this. But again, this is a graph you will have never seen looking at any period of time. A nearly 10% erosion in real weekly income by management and other non-production workers. This is looking at these sectors that have lost hours in the non-production and supervisory sectors. You have retail trade down 10.6%. You have, mining and logging obviously fell off because of a shift in oil prices, but, construction, wholesale trade, these are very, this is very interesting data that can only be obtained by disaggregating the headline data that we all look at. This came out this morning, so I figured I'd throw this in at the last minute. This is unit labor costs. We're all focused on this and saying, oh my God, unit labor costs, look how they've skyrocketed, and now they are bouncing back up again. If you start looking at all the other slides that I've just put up there, and then sit back and try to figure out why are unit labor costs skyrocketing, again, you have to disaggregate and try to figure it out in order to come up with a full picture, and in order to actually come to the correct conclusions with regard to where policy should be leading. And so the bottom line is, where do we go from here? I think analysis and policymaking, academic and in the media, especially because the media is sending out such powerful messages, needs to focus on jobs and labor at a far more granular level in order to make sense of these unique pandemic era factors. The impact on the economy and on inflation will not be a function of job losses, but of which jobs are lost or gained. Significant gains have been made by those with lower wage, lower hour sectors, and those are going to be jeopardized in a recession if a recession occurs. I think the risk of a full reversion to the status quo ante-pandemic is a real risk, and it's something that should be avoided. The question of why over 52% of net jobs formed during from pre-pandemic to present were supervisory requires far more research and understanding, and anchoring restrictive monetary policy or even fiscal policy to employment and labor aggregates risks missing critical nuances that would tend to indicate a far more patient approach. Oil, as Dimitri pointed out, obviously complicated matters significantly, but as we wake up this morning, oil is well into the $60 range domestically, and I think that problem has been removed. Inflation in the cost of non-capital goods and services is only problematic to the extent that it accelerates beyond the current rate of growth in personal incomes for more than a quarter of two, in my opinion. And Dimitri, you raised the T word, transient. I think the bottom line here is the pandemic produced a form of transient inflation. It's just transient for longer. Is really the bottom line. And with that, I return it to Joe.
Thank you, Daniel. That was great. Really good overview, and I like the transient for longer conclusion. Why don't we go to Pavlina, who also has a set of charts to get a further perspective on this question.
Okay, thank you, Joe. Thanks, everyone. Let me share my slide deck as well. I think our presentations connect nicely with Dan's. All right. Okay, so let me just get straight to it. I want to talk about three basic questions. And the first one is, well, is this as good as it gets? With all the talk of labor shortages, which I think that's kind of waning. Is this what full employment looks like? And then the second question is, well, if barring some engineered recession, some financial crisis, the softening that we seem to be seeing in the labor market, can we go further? And what would it look like to go further? What kind of policies does this presuppose? Does the current orientation of Bidenomics that is focusing on American-style industrial policy suggest that we might have a period of job-rich growth? And I actually agree with Dan's overall assessment that there are some underlying weaknesses that we really need to be thinking about, and that what we have today is very much a non-conventional growth episode. So, the way we normally look at labor market slack is by looking at these expanded definitions of the unemployment rate that looks at folks who are outside of the labor market who report that they want jobs now. And usually, that shows 2 to 3 times greater unemployment rate than the official one. I always like to take the temperature and look at it geographically, and which also tells us that there are large swaths of the population, the areas in the geographic areas in the United States that are experiencing elevated levels of unemployment. And that's pretty much a perennial condition. Even in the strongest jobs booms, we see many areas that have even double-digit unemployment rates. And they're not only rural areas. You can also look at the metropolitan areas. You see on the West Coast, on the East Coast, we have a high unemployment rate. So we are, that's not to say that, there aren't legitimate shortages in certain industries and certain labor markets, but those are very much regional micro stories. One way to look at labor market slack is to look at the flows data. And so we can take a look at who's finding employment. We find that those who go into employment predominantly come from folks not in the labor force. If those who find employment who have not had employment in the previous period. So if we exclude those the other group that finds employment tends to come from outside of the labor force, not from the officially unemployed. And even from outside of the labor force, they don't tend to come from the marginally attached. They tend to come from the group that reports that they do not want a job now. And so there's a lot more to be said about this, but this ratio is pretty stable, 60 to 75% of folks who find employment come from a category that I think is largely a black box. We don't have a full understanding of why folks are outside of the labor force. It could be benefits reasons, it could be care reasons. We can talk about this in the Q&A, but we can take a look at the annual social and economic supplement to the CPS report and try to glean some insights of why are people outside of the labor force. We know that there are these secular trends in the labor force statistics. For men, the labor force participation rate has been declining in the post-war era period. For women, there was progress in the 60s, 70s, 80s, but that has flatlined. And the decline in the overall labor force participation rate, it occurred to me, actually tracks quite nicely Dan's job quality index. But in any case, I think another thing to point out is that the US labor force activity rates are much lower than OECD countries, developed OECD countries. For women in particular, the flatlining, I think, is disturbing. As we know, women tend to take the service jobs. And if we have peak service employment, that will also help explain that flatlining. But on the other hand, European counterparts, they see increasing labor force participation rates for women and much higher. So that does suggest there are policies that can enable women to get into the labor market, like paid leave or childcare. But if we take a look at the prime working age folks who are not in the labor force by reason, care is a dominant reason. A greater proportion of women who are outside of the labor force are outside because of care responsibility. But the second most important reason is actually illness or disability. And that is number one for men. So we're working with the supplement to get the more current data, but looking at it from 1990 to 2015, the disability component has been increasing, has been rising as a share of the civilian non-institutional population. And the way I tend to think about this is that both home responsibilities and illness and disability are in some ways, especially illness and disability, in some ways are proxies for economic insecurity, that they're not necessarily a marker of physical inability to work or desire not to work. And when we look at how, if we look at folks outside of the labor force by education in prime working age, we find that that varies quite drastically by level of education. Low education, prime working age folks, higher proportion who report they're outside for reasons of illness and disability, very low for college graduates. And these are also the categories, the groups of categories that exit the labor force in greater numbers, the lower educated, prime working age men, women. Does that mean they're not ready and willing to work? No, it does not seem to be the case. I think a strong job growth shows that folks with disability enter into the labor market. It pulls in people into the labor market. So this is really kind of a small snapshot of the composition of folks outside of the labor force, but it is suggestive that there is a fair amount of pent-up potentially demand or even available pool of labor that would find employment if one were available. So I think here the story about quality of jobs, of readily available jobs, regionally available jobs is very much important to think more broadly about securing even tighter full employment. There's nothing magical with the 3.5% unemployment rate, and we can do much better. Okay, so who are the job creators? This is very similar to our chart that Dan showed in his presentation. Because we have seen these depressed labor force participation rates since the 1990s, I wanted to see where have we seen the job growth at that time, during that time, from 1990 to 2023. So we have, private education and health services have been growing fastest. Professional have added the most number of jobs, professional business services, leisure, hospitality, transportation, and government. Manufacturing, as we know, has been on this very secular decline. And even though we have seen quite an unusual growth in manufacturing in the last few years, again, that is part of this kind of non-conventional job growth episode rather than an indicator of some robust return of the manufacturing sector. In the last couple of years, again, we've seen some growth in construction and transportation and warehousing and information, but even information has been on has lost jobs over the last 25 odd years. So when we are looking at places of growth, again, very much the story is the service sector. The largest employers, so this is the number of employees in thousands. But if we look at who are the largest employers, when we look at the shares, we find that private education and health services, professional business and business services, as well as government, are the largest employers in the economy. And the way I tend to think about these three categories is that 2 out of the 3 are essentially either direct government jobs or underwritten significantly by government. The very large subsidies that are going to the health services, the kind of policy framework that we have with the care mandates, et cetera, is essentially a kind of industrial policy that is supporting the employment of this particular sector. We know that the large increase is rather in administration than doctors, but in any case, to me, this indicates that about 30% of total employment in the economy is supported by government policy, directly or indirectly. And I think the argument can be extended if we were to look at the kind of subsidies and support that the public sector provides to other industries, whether it is financial services and through procurement policies towards other industries. So the public sector, in a way, is an employer, a big employer, and it does it through, as I said, procurement or through direct employment. But when we look at the composition of government spending, we notice that over time, the share of public services or public investment has been declining. About 80%, this is since the 1960s, about 80% at the time of total government expenditures were current expenditures, that would be per public services or gross investment, whereas today only about 50%. So this is basically indicative of the rise of transfer payments, subsidies, and interest payments. Okay, so what this is suggestive is that in the early post-war era, the public sector was much more involved in, the kind of fiscal support that it provided to the economy was, centered around public employment and public investment, where today the way that we fiscal policy principally functions is through incentives, subsidies, and these kind of indirect ways in which we're trying to support the economy. So what does that mean for public policy going forward? Well, what that suggests to me is the following. First, the leading sectors are service sector jobs. The leading job creators are the service industries. Second, women have been outside of the labor force, and they tend to be employed in the service industry. There are barriers to employment, and they tend to deal with care responsibilities, but also the quality of employment has deteriorated. And so the kind of engine of employment growth, which has been the service sector, has really not has been weakening. And the manufacturing sector, although we are seeing kind of a renewed interest in manufacturing through the Build Back Better, through the CHIPS and Science Act, these are all well and good. But the way to think about them is that they are policies for the transition. They are not employment generating policies. So we need to separate these two in terms of the role of the public sector, in terms of the kind of economy that we are creating. And where the public sector can play a role, as I suggested, is in providing better support, better benefits that will spill over into the service sector. Increasing the minimum wage would be an obvious one. Providing paid family leave will be another. These will be very good workforce development policies, but they are not employment creation policies. And for that, we would need the public sector to do more and to do it in a much more direct fashion. Restoring, as you well know, I've long argued for direct public employment, targeted public employment, area-specific employment through an employer of last resort policies or job guarantees. But we need to be rethinking the framework of public fiscal policy and the way we pursue economic stabilization, not only on a short-term basis on how we emerge out of recessions, but also from a structural point of view. Are we implementing policies that can usher in a job-rich economic paradigm? And for that, the focus has to be on public service, and that might include community healthcare, that might include addressing food insecurity, that might include investments in the areas that are necessary for the green transition, improvements in the coastal areas that are experiencing the highest, most elevated levels of unemployment. So I think that, in fact, in this period of time, the case for a job guarantee and public employment is stronger than ever. It is precisely the time where we would want to implement programs at a regional level to put in place infrastructure that will be ready to absorb any labor or folks who might be laid off in the next downturn. And as Dan suggested, the most vulnerable remain vulnerable, and they will be the first ones laid off in the next downturn. And we need to have a preventative employment approach to mitigate this kind of rapid acceleration that we tend to observe in every downturn in unemployment. So again, marrying this understanding that we need preventative fiscal policy rather than reactive, with the specific concrete needs in various communities to address social deprivations, to enable people to find decent, stable employment. To me, this would be a kind of a framework, policy framework to go forward. Unfortunately, I think as we've seen in the negotiations, it is the childcare component. It was the civilian conservation corps component that were met with the greatest opposition. But I feel that this is exactly where we need to go for more robust employment growth. Thank you.
All right, Pavlina, thank you so, very much. And I think there's like a very excellent seg at the very end to go to Skanda Amarnath of Employ America and get your take on where we are and what tools we have available, perhaps, to address some of these things.
Fantastic. Thanks for having me. This is a great panel to be on. Let me share my screen, hopefully successfully. Hopefully you all can see this. Here's a bit of a summary of what I hope will be a description of what's happened, what's transpired in the labor market itself as it relates to employment, wages, specifically real wages, how much is causing inflation. But obviously there's an outlook that's also full of risks and uncertainties that also is worth discussing. I think it's worth taking first stock of what I would describe as quite a robust employment recovery, and one that from the standpoint of what we saw, not just in the 2010s, but also in the 2000s, and also in the 1990s, were sluggish, often jobless economic recoveries. This recovery has been far superior to any of those, considering the scale of job loss that was at play, not just in April 2020, but even as of January 2021, the US had substantially higher levels of employment loss than other OECD countries that had chosen a different path for employment preservation. And given how uncertain things looked at that time to be where we are, I think it's worth, this may be the, on the eve of another employment report. Who knows what it will tell us tomorrow. It could be more pessimistic, but as of the latest numbers we had from the March report, a number of key metrics hit cyclical highs, 20-year highs, 40-year highs, and that is worth, I think, celebrating, even as we should rightly note that that the labor market can still improve. This is not some kind of ceiling. This is not some point where further improvement require some sort of Herculean effort, but we can at least note that this has been a robust recovery. I would say the recovery is robust, especially when you consider the aging of the population and where people are moving into the years when they are more likely to retire or at least be in their retirement years. And certainly while we are Employ America, employing grandma and grandpa is not always the right call for what's optimal for the economy as a whole. We see full-time employment in particular has outperformed part-time employment in this recovery, and full-time employment rates are well through the highs of the previous expansion. Racial employment gaps have seriously narrowed, especially when you adjust for age. They are now at 40-year levels of compression almost, so that's pretty remarkable. On wage growth, we've seen nominal wage growth look quite strong. I suspect for reasons that are largely the result of some transitional aspects of the reopening. It's also worth noting that lowest wage workers are the ones seeing the highest nominal wage increases. And on real wages, I think the discussions we had for structurally, the US labor market does not lend itself to cost of living increases in the face of inflation. And so we've had a lot of causes of inflation that are simply not met with commensurate compensation increases. I would highlight supply chains, geopolitical shocks, what I'd call demand speed limit effects. I think it is okay to say demand is the proximate cause for certain parts of inflation, but those are largely a function of demand recovering as a result of reopening, demand recovering purely because we wanted to get a lot of the lost jobs back quickly. I really take issue with the notion that in a very serious sense, inflation is being caused by wage growth, is being driven by wage growth, or even labor shortages, even in the services sector. If we take a more hard-nosed, disaggregated view of inflation, what we will find are many places where supply chains affect services, geopolitical shocks affect services. This is not it's the goods and services divide. We have to be careful about how we describe this. So with that sort of summary in place, I don't have a lot of charts, but or at least I think that's far fewer than Pavlina and Daniel, but I think it should still be very helpful for this discussion. If I can scan through it. Okay, there we go. As a summary statistic for the labor market, one that it has a reasonable sample size, adjusts for the fact that participation is dynamic, is cyclical, adjusts for the fact that the aging of the population means we need to actually appropriately account for that and not simply assume that even as the population is getting older, that they are going to be employed at the same rate or propensity. And I don't think it's like worthwhile to say that it's we should be optimizing for everyone from 15-year-olds all the way up to 95-year-olds should all be employed. We should really focus on the cohorts that really are usually past their educational attainment years and before they are considering retirement. 25 to 54 is an approximation, but we could look at obviously proximate cohorts, 20 to 24. We could look at 65 to 69, so 55 to 59 or 60 to 64. We'll see a very similar conclusion. We're now through the pre-pandemic peak. That doesn't mean it can't improve further. I actually think it can, and especially as if this expansion continues, the U.S. labor market has not looked this good in terms of employment adjusted for age since about 2001. That's a long time. It doesn't mean it can't get better. It doesn't mean that anything further from here is inflationary. I think we should reject that that sort of casting as if we have run out of workers now. I don't believe that's true, and I will sort of discuss at the end some reasons for hope on this front for why further progress is actually very feasible if we can avoid recessionary shocks and outcomes. I would highlight, compared to the previous expansion, which had a large share of part-time employment, and part-time employment was outperforming full-time employment, that has not been the case in this brief but rapid recovery. Here is that same prime age metric, but just looking at full-time employment, which actually recovered to 2020, recovered in last year itself to the pre-pandemic peak, and is now making new highs, and is now pushing some of the limits that we saw pushing some of the peaks we saw in the late 1990s and early 2000s. So the job quality is certainly could be better in the United States, but I think it's also fair to say it's better than what it was in the sort of pre-pandemic era. It could full-time versus part-time is not the only way to slice it. There's so many other things that go into it that should matter, but typically speaking, part-time employment oftentimes is a form of underemployment, and underemployment is a very hard thing to measure. So people who work part-time for economic reasons, there is a line item in the U.S. household survey for employment. That line item will tell you people working part-time for economic reasons is historically low. But those survey questions are actually very hard to parse perfectly. And if we try to, it's hard to get systematic measures across countries. So it's just a simple robustness check. We could just look at full-time versus part-time. In general, people who want to work typically would prefer the security of a full-time job over having to take multiple part-time jobs. And we actually see, even though multiple job holders is a very cyclical metric, so in expansions it tends to go up, it's gone up less in this expansion. So multiple job holders obviously has increased, but it's quite clear to that this is that fewer people are entering, are taking multiple jobs in this expansion, given where we are on a benchmark like the unemployment rate or a prime age employment rate. So that underperformance is also potentially something to take heart in. I think we've also seen this is actually been a very egalitarian recovery now, is becoming increasingly clear. So if we look at the Black prime age employment rate, specifically among the Black community, among African Americans, that is now pushing up against the peaks we saw in the again, the late 1990s. We had a little spike in 1998, approximately speaking. If we took a 12-month moving average, you will see that this is right at the sort of peak levels. And I think this has all been a function of the cyclical state, is really what should be important to note. People talk a lot about structural reforms, all sorts of things that need to be done through Herculean legislative exercise. But I think the combination of primarily accommodative fiscal policy, and only until probably the last 15 months, we had offsetting monetary policy. But prior to that, we had the conditions that allowed for a rapid take-up of employment, and that has accrued to those who have historically been stigmatized, marginalized in the labor market. And I think that is a very good thing that we should, again, celebrate and try to preserve and defend and build upon. That is especially clear when you start to look at the differentials between white prime age employment and Black prime age employment. Black prime age employment tends to be lower than white prime age employment, especially after adjusting for age. But that gap has narrowed substantially and now is pushing on what would probably be over 40-year lows in that differential. So what we find, especially in these metrics of, I call it equality, egalitarianism, we see that there is the cyclical state matters. The cyclical state really matters, and the fact that we have been able to rapidly tighten labor markets, at least in terms of the quantity of employment, that is all else equal a very good thing. And I think it's, again, stuff that tends to be in the process of talking about inflation all the time and talking about, and not that inflation doesn't have a set of challenges for all sorts of people and communities that needs to be, deserves like serious analysis and serious policies. But it is worth trying to really reckon with how quickly things have improved, how much they've actually changed what we see in terms of sort of the employment gaps in among different racial groups. I haven't posted it here, but a very similar thing that I think Pavlina brought up, which was that people's education attainment levels, people who typically have lower educational attainment levels, tend to be those who are put at the back of the queue in terms of hiring, those who have only a high school diploma. But those differentials have also closed. So we see on a number of dimensions where the labor market left to its own devices will discriminate, but in a tighter market is forced to at least think about people who maybe otherwise are ignored. Again, these are like all of the positive stories. There are obviously plenty of negative stories. I think it's, and I think there are obviously risks to the outlook, but I think it's just worth taking stock of where we are. And the fact that even this was for 25, 30 years deemed impossible, deemed to be structurally intractable or structurally only possible if Congress passes the most fanciful legislation. But actually, there are a lot of things that if we do the big stuff right, the macro policies, if we get those right, it can just do a lot of good. We're talking about millions and millions of people here. If you think about a 1 percentage point differential, that's a lot of people. If you think about it, going from 10% in 2011 to now under 4%. That's just and this is something that has mostly been about lifting up those who are marginalized. It's not about white people somehow being employed less. So this is the kind of positive equalizing story that I think deserves to be told more than has been the case, I'd say, across media and across economic commentators generally. I'm going off the discussion of wage growth, and I think it's actually it's important to note a few things here. Nominal wage growth stronger than it was for most of the pre-pandemic expansion. On some measures, it's coming down. But what's really interesting is the cross-section of outcomes. At least this is a chart from Arun Dubé that got published in the Financial Times. I cribbed this, so thanks to him for putting this together and FD publishing it. But it just shows you, it says it's a real hourly wage index. I think there's a little bit of a problem with saying it's a real wage index for different parts of distribution. But what you can see quite clearly is that this has been, even amidst very high inflation, for a lot of people who are working low wage jobs that are now in higher demand, whether they were in leisure and hospitality, whether they were in transportation services, whether they were in a number of categories that were typically looked at to be dispensable. Healthcare is another good example where now, because there's an exodus to deal with, because healthcare service jobs are often of varying quality. People are not always treated the best, and they are having to compete now in terms of job quality, wage compensation needs to be much more competitive. I think these are dynamics we need to make sure persist and continue. I don't think of them as inherently inflationary. It's part of it is going to be about actually making these jobs better jobs, more productive jobs, jobs that are valued and not treated as things that can be just easily liquidated in the first sign of a downturn. We saw a lot of people burn out in the healthcare sector, and they've now switched to other sectors. And that's a large part was driven also some of the earnings power for those at the bottom is that they've had a chance to switch jobs. They have some kind of leverage, some kind of bargaining power. It hasn't translated always into real wage gains, although the fact is, yeah, for their real wages to even hold up amidst very high price inflation is remarkable in its own right. Obviously, you don't want to see people have major real wage declines in general. I don't think that's although I also say real wages are kind of a problematic concept for a lot of reasons that I'll get into in the next slide, which is just to say everyone's consumer price basket, their consumption basket is different. And so one of the things that's probably been most frustrating about this kind of recovery, even though it's been very excellent in terms of job growth and even decent in terms of nominal wage growth, but price inflation has been a big thorn in the side. I don't think these are primarily sort of intractable labor-driven phenomena. I'll give the examples that really matter in terms of for the lowest income people, what really counts are, we talk about energy, we talk about food, we talk about rent, maybe utility costs in general. These are things that generally occupy a much larger share of lower income households' budgets. So this data comes from the Consumer Expenditure Survey. This data will tell you that not everyone consumes the same things. Generally speaking, people who at the lower end have a more commodity intensive budget. So they're generally living paycheck to paycheck, and commodities, food, energy, housing will occupy more of their monthly payments as a result. Thinking about how to make those prices stable is especially important as a result, and how to do that in a way that is still resilient. I think it makes the Fed's disinflationary attack quite perverse because it doesn't really get at any of these problems in any direct sense, except to hope that employment is less abundant. So I find it very frustrating when this is being used as, yes, the lower income people will face some inflationary shocks in very disparate and counter-egalitarian ways. But the notion that the Fed is somehow doing a service to equality and a service to all Americans by trying to crush inflation seems very misguided and almost wrapping them as a bit of a wolf wrapping itself in clothes of a sheep. It seems like it's very clearly not the case that the Fed has direct, I think Jay Powell has even admitted to this, is saying that food and energy, for example, are not things that the Fed thinks they have great influence over. Even rental supply is funded by debt primarily. Rental supply, if it's funded by debt, then actually raising interest rates would be supply negative. The only way that it can be reducing rent is largely through the labor market. I think it's worth just being very clear about that mechanism and not to say, oh, because we have inflation, the key to and inflation maybe even having unequal impact, the notion that this has to mean we should be trying to crush the labor market to solve that problem seems especially perverse because crushing the labor market is highly unequal in terms of who ends up losing their jobs, who ends up losing their bargaining power as a result. I'm going to move a little bit more now towards a discussion of what actually is driving inflation. I've some things that I think are common. I would call it there's a tendency to scapegoat the labor market. There's a tendency to scapegoat too many people have jobs, too many job openings, wages must be too high, and that must be either pushing up costs. I would instead think about this at a little more granular level and just think about the causes driving some of these categories. The Fed has said, okay, maybe the goods prices have been about supply chains. Yes, there's food and energy that may have been affected by some other shocks, but how can you possibly explain the fact that, and even the Fed's even willing to say rent inflation may be something that is a lagged process market rents are starting to flatten out, albeit at very high levels. But we are seeing signs that rent inflation is not on some runaway train. In the private sector data, it will take time to show up in CPI. They've said all of that, but they have also said, well, what about these sort of non-housing core services? What about all these other services? They're seeing very high rates of inflation too, or at least elevated rates of inflation. A big chunk of that category, especially when you think about the volatility, would be, for example, airfares. I'm not saying airfares is all of it, but it's a good paradigmatic example because there are a lot of things going on with airfares. Airfares are still running at very high high teens in terms of year-over-year growth rates. If you think about it, Omicron was just 15 months ago. Still having an impact on the data. So it's the notion that this was we're still seeing a lot of base effect dynamics that are likely at play there. But also some other phenomena I want to highlight, and this is coming courtesy of my colleague Alex Williams, who documented. We talk a lot about pilot shortages, flight attendant shortages, but if you really look at some of the most proximate causes of airline fare inflation, you'll find that jet fuel is quite a good proxy for what's coming, because jet fuel, even if it is not the largest share of airlines costs, jet fuel is the most volatile contributor to their cost structure. That is the most variable part of the aggregate cost structure of airlines. It's what their CEOs talk about most prominently in terms of why costs are up or down. And they have to try to find ways to mitigate that risk. One way is to probably hedge your costs directly. And the other would be to use prices to try and offset to pass through prices in response to changes in jet fuel prices. If you see this, I don't want to tell you correlation is causation, but I think it is worth thinking about the big episodic moves in airline fares and airline fare inflation, and thinking about that in the context of the big changes in jet fuel relative to in the green line. That's a good example of the opposite, is what wage growth looks like in this sector. And I would say it's generally not very compelling to drive your models for airline inflation through labor cost channels. And there have been times when labor costs have even spiked more aggressively. It grew at something like 20% in 2013. It did not have a really substantial impact on where airline fares tracked. In fact, what we ended up seeing is that typically on the way up, there is a rockets effect, where specifically when costs blow out, specifically commodity costs blow out, and they can no longer be absorbed into margin without some kind of shareholder revolt, the firms tend to try to push through prices more aggressively. The effect is nonlinear. On the way down, we did see after the decline in oil prices in 2014 and through 16, it took a lot longer for those declines to be passed through to airfare. They did pass through, but it took about a few years. And here's a sort of separate chart to kind of indicate that. And so, I'm sorry to sort of probably follow on here, but at least I would say it's rockets on the way up and feathers on the way down. The final chart, just to kind of round out some of the things that you think about. Obviously, the pandemic sort of cutting off air travel and then the subsequent reopening is a big driver of airfares and jet fuel prices. No doubt about that. What people didn't think about was when Russia invaded Ukraine, and all of a sudden there was a lot of sanctioning and self-sanctioning policies that cut off access to Russian refining capacity. We had a pretty deep refining bottleneck globally. That may have been exacerbated by some other phenomena simultaneously, but it's just worth thinking about. If jet fuel prices surge because of a lack of refining capacity, that is still a cost that has to be absorbed by airlines, and that tends to be passed through in terms of higher airline fare inflation. Again, nowhere in this story did I bring up the wages of the workers, and obviously wages may be moving, but I think this notion of we are out of pilots, we are out of flight attendants, and this is the primary cause of airfare inflation is completely misguided. I would say it's primarily a function of reopening and the fact that we had a big refining bottleneck. We're starting to see jet fuel prices come down. I would say hold your horses if you think that airfares are just going to come down one for one right away. But with enough time, with jet fuel prices substantially lower, we probably will see airfares also correct to a decent degree, or at least stabilize. And that would mean a much lower inflation rate than what we would have seen in so much of the sort of 2021, 2022 period. I'm going to just give another example of sort of the goods services phenomena that have a lot of overlaps. Again, this is a place where people talk about food services being very labor intensive. And so it must be that because we can see signs that food services companies are paying their workers more, they must be raising prices because of it. I would also highlight here, food is a place where we see a lot of, if you believe food supply shocks are very common, if you believe that they affect grocery store prices, as they did for eggs, as they did for so many different categories, you should probably also believe that they have a pretty substantial effect on restaurant pricing, because restaurant pricing also is a function of their competition, the grocery store, and they also have shared inputs, shared material inputs. I think there's a tendency to, again, here to say it's all about labor, labor is the cause, and I think that's it's an easy simplified view, but I think it actually becomes very complicated when you start to bring in the material world into the consideration. Commodity production, commodity inputs, the cost reflected into those is typically not the dominant wage paid in America. There's a whole set of plant, equipment, inventory, physical capacity is a big part of the story. And I think that's something, how to keep that resilient will be a big part of how rethink how we use macroeconomic policy to address inflation separately from trying to hope that it crushes the labor markets. I've discussed supply chains, goods and services, geopolitical shocks, but I'd be remiss to not mention what I think is also a play with the big chunk, probably the most inflationary part of what we call core inflation, and how that is, again, I would say this is a part of the complex I would actually be willing to admit. The labor market plays a role, but not the kind of role people think. The labor market plays a role from the demand side for how rents in America tend to be priced. Landlords tend to price rents in response to what people are willing to pay. They price at the margin. They don't price based on construction cost or the cost of a maintenance worker. They charge what they can to people, prospective renters. Rent inflation tends to respond with a lag to what we see in the labor market. What I have in red is a combination of job growth, prime age employment, and wage growth. Employment cost index I'm using here. You can use compensation, you can use wages and salaries. The combination of those two give you a sense of what's the pool of labor income that may be available for landlords to extract in terms of the rents they charge. In that case, you see, when we had a big spike in 2020, 2021, in labor income. We wanted to have that, by the way. I think that's something that should also be very clear. We would like to have the jobs back quickly. It was a very conscious decision or preference in 2021 when policy was made and when people saw the depths of what happened during the pandemic. Unfortunately, we've kind of forgotten the fact that that would also mean for a period of time, you would see a big spike in certain types of cyclical demand sources where when people are able to earn a paycheck, they're able to form households a little more easily. When they're able to form households and they need maybe a little more floor space, there may be some other pandemic related dynamics here. I'm not here to say it's all about labor, and I don't think it's about labor from a cost perspective, just to be clear. But these kind of speed limit effects, this is a good example of a speed limit effect where we have a one-time surge in growth. We want to have the one-time surge in growth. I'm not saying that growth needs to look exactly like it did in the pandemic reopening phase. So that is a place where labor likely did have some intermediating role in prices, but not of the kind that people should. And it's a kind of dynamic that will effectively probably play out over a 2.5 to 3 year period because of the lags in CPI methodology. So I wouldn't say, again, this is these metrics should come down. I'm showing you here a year-over-year percent change in the 4-quarter moving average, just to kind of keep things smooth and optically attractive. there are signs that rent inflation is starting to slow. It probably will take time. It is not something, again, that crushing the labor market to solve is a very bright idea. But unfortunately, that is effectively what policymakers are thinking right now when they see that, oh, rent inflation's, people must be struggling with rent. The key is to raise interest rates, as if raising interest rates can work through any mechanism other than the labor market to cool rent inflation. If anything, it's more perverse through alternative mechanisms. I will round out with a couple of slides just about, one is the risks. I do see some signs that do concern me. The fact that we do see signs of permanent layoffs right now in the household survey. When those numbers go up, pay attention. We could be on the cusp of a recession. We may not, but this is probably the most concerning data point I see right now. And the worst thing about layoffs is they tend to snowball. So while I don't think every single data point suggests that layoffs are snowballing right this second, and it is odd to see this at the very same time that I was telling you all that good news about employment rates at new highs, it is really, we are at a juncture where risks are high. Ideally, given that the Fed is, for better and worse, the lone macroeconomic policymaker with discretion right now, should be operating with heightened prudence, kind they have not exhibited thus far, but is essential in this moment. We have a labor market that maybe is showing signs of deterioration. Maybe there's somewhat higher permanent layoffs, but there's an elevated hiring rate that can absorb that over time. That's plausible. There are a lot of things that look very much like they've never been consistent with the recession. And there's a data point like this that is highly consistent with recession. I would pay attention to tomorrow's numbers on this particular score. It's interesting to see this rise even as unemployment as a whole stayed steady and participation rose last month, has been rising, I should say. So it's a mixed picture, but this is probably the most concerning data point. And it largely seems to be among white collar workers. If you look through the micro data here, it seems to be on an occupational basis, white collar occupations that have largely been driving this phenomenon in the last few months. So that's the place that I'd be paying attention. Should we be able to preserve the expansion? And I'm going to leave on an optimistic note. This notion that of running out of workers, or because employment rates are high, they can't get any higher, is just flatly wrong if you look at other countries. They are able to make new peaks, and not new peaks as a result of inflation. If you're of the mindset that tighter labor markets inherently cause inflation, just look at Canada, Japan, New Zealand, United Kingdom, Australia. You can look at other countries too in the OECD, and they all show you the same pattern. They tend to go up over time if you can avoid recession. The US had a pretty deep labor market recession, 2001 to 2003, that set it back, and an especially deep recession following the financial crisis in 2008-9. That set the US as the laggard in terms of labor market outcomes, and we don't have to settle for those outcomes. We can do better, especially if we can avoid recessionary outcomes and bounce back from them quickly. I think we bounced back from this past recession quite admirably. It's now about preserving and defending this expansion, which is that the risks are high, but there's all to play for still.
All right. Well, Skanda, thank you so much. I think between the three of you, that was an excellent roundup of where things stand from different perspectives. We have a few minutes here for questions. I should have said during the intro, if anyone attending or watching wants to throw in a question into the Q&A bucket, you can do that. There are some in the queue right now. So I want to go to a question from Tom Weir that I think is sort of interesting and speaks to where Daniel left off. It's like, okay, transient, but maybe longer, a long transient period. People don't like inflation. There's an impulse to bring it down. And so, like, does the Fed, and Skanda, as you pointed out, some of these tools are pretty clumsy. I don't even think there's much controversy about that. Does this have to be a conversation about new tools, or are there existing tools, whether at the Fed or elsewhere, that could be used to address some of these things within the political constraints of, what the Fed basically has available to it, thinking about solving some of these problems?
I'll take that if you don't mind. I think the couple of things. First, I do think a discussion of the 2% target is a legitimate one. The idea of having to immediately recover to 2% inflation in the short term, I think is pushing things a little bit too hard. I think a world with slightly higher persistent inflation, 2.5%, it's not going to kill anybody as long as wages and incomes continue along that path. Keep in mind the lesson of the 1970s is not that all inflation is bad. It's that lagging growth in wages and incomes is really, really bad. In the 1970s, the lag was about 18 months. And when Volcker came in and shut the door on price inflation, effectively, wages caught up, and then we were off to the races in the 1980s. So it's that lag that's really the painful thing in the economy that causes the stagnation that everybody seeks to avoid. Here we have arguably the opposite. We actually have for many of the people, as the graphs I presented indicated, we have incomes growing pretty much along the lines with inflation. So that begs the question of whose inflation are we worried about anyway? And the Skanda's slide from the FT, I think, spoke to that as well. When you look at the top 10%, when you look at the graph that I showed with respect to management and supervisory workers, you have to at least ask the question, do people with a lot of political influence who's are feeling the bite of inflation because their incomes have actually been eroded, and I'm talking about people in the upper quintiles, are they having way too much impact on policy? Now, I'm not saying that I've reached that conclusion, but I think it's worth asking the question because, as Skanda pointed out, and as Pavlina pointed out, and as my deck showed, the folks in the bottom have done fairly well, notwithstanding that there is a lot of pressure on housing, which I think is the outlier, and as the fact that I think Minsky wrote extensively on two-track inflation, is influenced by many other things. Skanda talked about the willingness of the market to pay, but you also have to look at the fact that when people have embedded costs on a capital level and have to recover those costs, have to make underlying mortgage payments and returns to their investors, they are willing in a low interest rate environment to sit with vacancies for an enormous period of time in the rental housing market. And we see this as a phenomenon when we have interest rates very close to zero, is that landlords are willing to sit with vacancies that cost them very little to carry, and that creates until they get their number, so to speak, and that creates some very, very artificial effects in housing. So there's a lot of stuff going on in housing that I think is poorly understood.
Pavlina, do you want to jump in on this question?
Well, I mean, I think the question boils down to where's the appropriate policy lever to handle inflation. And I think, the convention is looking to the Fed. We're going to have a whole panel on inflation. We'll see where the sources are. I think that there's a significant role for procurement to play. There are other policies that can deal with some of this cost push inflation, et cetera. But, for me, the question is really, yes, we can go further. Clearly the labor market is not, at its best. And how can we get there in an non-inflationary way? And, from a policy perspective, as Skanda was showing, there are inflation-sensitive items, food being one. There's a policy there for kind of, sustainable agriculture, if you will, more affordable, more accessible. There are various kind of low-hanging fruit policies that can both connect the employment piece with alleviating some of these price pressures that folks are seeing in key items.
Great. We have a few more minutes to go on with this. I want to get to another question. One thing, we're talking about the end potentially risks to this cycle, potentially risk to employment, particularly what we're seeing in the market, with the Fed, et cetera. How are any of you thinking about the impacts? This question is sort of inspired by a question from Daniel of the Build Back Better, which strikes and some of the Inflation Reduction Act, ongoing public investment, public, private, et cetera, positive fiscal impulse. How are some of you thinking about sort of like the macro effects of these sort of longer moving, slower moving, but fairly substantial public investment programs that were passed during the first 2 years of the Biden administration? Maybe Skanda, you could start with that, and then I can go on.
Look, we've done a lot of, at least in terms of relative to history, from 2020 through to 2022, and quite a number of different measures to support the economy, support the labor market, support investment, and as a result of all of that is supporting private sector balance sheets. And I think of that as we have probably changed a number of balance sheet structures inadvertently, at least, in terms of that, plus a Fed that, at least until 2021, probably supported a lot of refinancing of debt, stronger capital structures, potentially. That's at least one more optimistic reading. It's obviously one where you need a lot more data to be able to say with any high confidence. But it is something that I think about a lot from the standpoint. There's actually an opportunity. Oftentimes we talk about, wouldn't it be great if we had shovel-ready projects, we could do public investment? And unfortunately, those things take a long time to actually execute. And there is no such thing as a shovel-ready project. But we have enacted a lot of legislation that can be used to actually provide the kind of fiscal policy support that is direct spending and not merely transfers, and to actually help keep animal spirits at least on a more stable footing, so that we do not end up cycling from risk on to risk off, from risk seeking to risk averse behavior. So there's like an opportunity within all the enacted legislation to be able to provide that kind of stabilizing force, but it requires a lot of government coordination. And they have to think about how best to leverage that. That's going to be something right now, I guess, for the Biden administration should be thinking about, because look, there are just a lot of reasons to think that things might work better or worse in the future. But fiscal policy, it's not as if there aren't opportunities to use what's enacted. Ideally, there's also some thought into how to cobble the coalition for a lot of the things that got left out of Build Back Better, to find a way to move that forward, that agenda, because that agenda probably would be more ideally labor enhancing, making a lot of their jobs more stable, attractive sources of employment versus what they currently are, which is very fragile and clearly not the kinds of things where people are compensated appropriately.
Joe, if I could add,
Please.
I'm not seeing anything in the data yet on manufacturing and construction that would indicate that we're seeing a surge from the Build Back Better Act or from any other industrial policy, both of which I strongly favor. But the truth is that we have two countervailing forces out there. Obviously, I look every month to try to see some indication of non-residential construction activity, being enhanced by Build Back Better, and other areas that in manufacturing that would be enhanced by the infrastructure, an infrastructure surge. It's not happening yet. We're seeing continued declines in PMI and other data in those sectors. However, and the fact is that we are going to see a major contraction in non-residential construction caused by one of the largest sectors, which is urban office, which is going to come to a complete halt. It has come to a complete halt and is going to continue that way for a while. given the massive vacancy. Urban retail and retail around the country in general is going to come to a complete halt. And hopefully some of this infrastructure employment is going to offset that. So the answer is no, I don't see a big problem. The answer to the questioner is I don't see a big problem from an inflationary standpoint because we have some sectors that are absolutely dying on the vine that are going to need to be bolstered by new forms of employment to replace them.
Yeah, maybe if I can add, I tend to think about this in the context of the orientation of fiscal policy. The Build Back Better is still working through, tax credits, incentives, etc. I mean, it's not that large, to be perfectly frank. There will be an effect on balance sheets. And the question is whose balance sheets? And can we anticipate that the demand for product in a particular sector is going to translate for demand for product in a labor intensive sector? And I think that it's a stretch. I just want to give a hat tip to David Dan, who, talks about government procurement. Even in the cases where we have direct investment in public infrastructure, the bang for the buck is relatively small because of the kind of consultification of the process. And so for me, the employment effects, you can have big spending, big government, big deficit, low growth, low employment growth, as we have seen time and again in the last few decades. So the question is really like the levers through which we are creating better jobs. And, manufacturing is dying on the vine. And so I separate these things. It's necessary to create sort of the battery belt. It's necessary to create the technologies for the transition, but let's not confuse it for an employment generating policy.
Another question from the viewers. So a lot of awareness these days about the role of expanding profit margins, companies trying to regain their margin. People talk about corporate greed. Things like that in terms of driving pricing behavior right now. Something I'm curious, is there a policy implication to be taken from this? It's like, okay, companies are raising prices because they want to make more money. Not surprising on some level, that's what companies do in a capitalist economy. But as we are aware of companies not necessarily just having, it's not just a function of labor, it's not just a function of demand, it's not just a function of commodities. Is there some policy implication from this reframing that we can think of that might guide us towards a better approach to managing macro policy?
Companies are always going to raise prices to the extent that they can without eroding unit demand. That's just a fact of life in the private sector. As soon as unit demand is threatened, they're going to stop raising prices, and that is what we're seeing here. The demand slides that I showed, the fact that we have improved incomes in many areas, but we also have this very substantial excess savings cushion, has created for the time being, and hopefully it's not that much longer, excess demand that companies can price into. That is starting to diminish, and you can see it across the economy. And when that dissipates and ends, prices will stabilize. But you can blame companies for price gouging or for going after the last buck and doing it in excess of what their increased labor costs are. But the fact is that's what they're supposed to do. And they are going to always do that in a capitalist economy.
Pavlina, Skanda, thoughts on this question, on this line, this analytical line?
Yeah, I mean, I think on some level, it should reveal with any kind of cost structure that's being used as a reason, an excuse to push pricing to its maximal level. That should be in a more dynamic government. You would be thinking about how to incite more productive competition against that, where it is being pushed to the limit, finding ways of, I think for a lot of industries that really see the need to make hay while the sun shines, it's about the cyclicality of the industry. That may be a little more charitable view of industry behavior, but it actually lends itself to a view that suggests finding ways to cut out cyclicality on the upside or the downside is actually very important to making prices stable or sticky. And to do that, you have to think actually about the real side of the economy. I think it actually means like thinking about how do you invest in more resilience? How do you make sure spare capacity is available when you really need it? When I'm talking about spare capacity, I'm not talking primarily about labor. I'm talking about plant equipment inventory. Some of that has some infrastructural benefits to make sure there's enough available in the face of a war, pandemic, in the face of all that. Because in the absence of sufficient supply, sufficient capacity, yes, that price gouging behavior will be something that emerges in a variety of forms. I don't want to sound like industries can or should do whatever they want, but also black markets crop up in a lot of countries where this kind of behavior emerges when there is actual shortages at play. So thinking about how to cut out a lot of these types of behavior, are also thinking about how to promote productive competition where you can, and also building more resilience and abundance where necessary and appropriate, because we're dealing ultimately with necessities and non-discretionary forms of consumption.
Pavlina, any final thoughts on that?
I mean, I agree completely with everything that was said. I just want to highlight that first, labor market is not the source of inflation. That we will discuss what the supply side issues are, but it is at the end of the day a financed problem, right? That price increases can manifest as long as they're being validated by the macro structure. And that will happen with the various sources of demand that are out there. So the demand is not the source of inflation, but inflation cannot be sustained if it's not validated. And to the extent that the Federal Reserve is trying to crush, to soften demand conditions, it's actually a very painful way of dealing with inflationary pressures, right? We're kind of undermining sort of the small progress that we've been able to eke out in the last 2 years to deal with the inflationary pressures that are not originated from the demand side. So.
Well, on that note, I apologize. There's a lot of questions we weren't able to get answered, but some of them hopefully get addressed on the panels coming up. Running a little bit over time. So Pavlina, Skanda, Daniel, thank you so much for your time. It was a fascinating discussion. Thank you to the Levy Institute for inviting us. And that was great. And I guess there's a little bit of a break now.
Thank you.
Thank you.
Thank you.
See.